Welcome to Woods of Stardon. This is CH. I will be covering the Man Dynamic Income Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Algebris Financial Credit Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. Man Group was founded in 1783 by James Mann and was originally a sugar cooperative and brokerage in London. It expanded into broader commodities trading in 1802, growing its roots in Commodities Trading Advisor or CTA and trend-following strategies. With financial exchanges becoming available to hedge commodity exposures, Man gradually diversified into financial services and investment management in 1983. The firm was renamed ED&F Man in 1869 based on the initials of the grandsons of James. In the year 2000, however, the company divided into two separate businesses, with Man Group plc focusing on financial services and the commodities division ED&F Man taken private. Given its CTA roots, Man has been a strong advocate of quantitative investing strategies. Man launched a joint project with University of Oxford to create a research institute focusing on quantitative finance, and subsequently expanded into machine learning and data analytics. Much of the firm's growth was attributed to acquisitions. The first important acquisition was in 1989 of AHL, one of the three then leading trend-following hedge fund managers globally. Man subsequently acquired discretionary manager GLG Partners in 2010, fund of hedge funds manager FRM in 2012, systematic equity manager Numeric Investors in 2014, private equity Alto Invest in 2017, and private credit Varagon Capital Partners in 2023. Man retains the individual branding of these specialist managers under its multi-manager structure, and today is a leading global active investment management firm with over $220 billion of assets. The AHL and Numeric businesses offer quantitative hedge fund strategies. Alto and Varagon businesses offer private equity and private credit solutions. And GLG and FRM businesses provide a wide range of fundamental research-driven long-only and alternative strategies. The Man Dynamic Income Fund is a sub-fund under the Man Funds plc fund family. The fund family is set up as an Irish ICVC company structure and is UCITS compliant. The fund is registered as a MAS restricted scheme, which means it is suitable only for accredited investors. Therefore, you may find the fund appearing in some of the distributors' product offering list, but not immediately accessible unless you disclose your accredited investor status. The Man Dynamic Income Fund webpage indicates Jonathan Golan as the only portfolio manager for this fund. Jonathan joined Man Group in mid-2021 and incepted this fund in mid-2022. Therefore, he is considered key man risk for the fund. He is also responsible for several other bond funds in the firm. While it is stated that Jonathan was previously with Schroders since 2013, there is actually very little public information on his roles and responsibilities in Schroders. The fund webpage also indicates the investment manager as GLG Partners, so this fund falls under the Man GLG business arm. The Man Dynamic Income Fund provides quite a bit of information in its investment policy in the fund webpage and fact sheet. The investment objective is to provide both income and capital growth over a medium to long-term period, which we would normally assume to be at least 3 to 5 years. This is essentially a global bond fund that focuses on corporate bonds and, to a lesser extent, securitized assets including MBS and ABS. Government bonds is notably not a priority, which means this fund is potentially suitable for investors who do not like government bonds or who already have too much government bonds exposures. Derivatives are also mentioned, although we will see later if there are disclosures of actual derivatives usage. It is briefly mentioned that the fund uses a bottom-up investment approach, and hopefully we will find more details on this in the prospectus. It is also stated here that the fund does not have a benchmark. I generally do not like funds that have no defined benchmarks or target objectives, as it makes performance assessment difficult since we don't really know if the fund is performing as intended. Let's go through the prospectus for more details. There is actually a lot more information in the prospectus, so let's spend some time to go through them. The first section is called Investment Approach that details the investment process. Here, it states the fund has a mandate to invest at least 80% into global government, corporate, or securitized bonds denominated in US dollars or hedged to US dollars. From this, it is clear the fund avoids FX as a returns generator. It also implies that the fund has the flexibility of allocating up to 20% in other asset classes, though generally we would expect a bond fund to stick primarily to bonds. The fund can also invest across the full range of capital structures that includes the riskier subordinated bonds. The prospectus then elaborates on the bottom-up investment approach. The fund adopts an investment philosophy focusing on buying bonds with yield spread higher than the assessed fair value and selling bonds when the price reaches the assessed fair value, profiting on the income and capital appreciation during the holding period. This is done with rigorous analysis on the company's financial statements and business fundamentals, with an emphasis on ensuring issuer solvency and ability to repay the bond through sustainable cash generation. The analysis covers a slew of business factors, including competitive dynamics, supply chains, financings, customer bases, etc. Capital structure and covenants built into the bond issue are also factors taken into account in the analysis. The fund does consider macro factors to complement the bottom-up investment process. As with other flexible bond funds in the market, the fund will not have any fixed geographic or sectoral focus. The fund has the flexibility to allocate max 40% in emerging markets, and also has no constraints on credit rating exposures. Therefore, it is possible for the fund to tilt aggressively into high-yield bonds. Investors should take note of this if you are looking more for an investment-grade focused solution. The next section is called Investment Instruments and Asset Classes, that covers in more details the types of bonds the fund invests in. As earlier mentioned, this is a fund that focuses mainly on corporate bonds. While the fund can invest in government bonds, it will do so only if the bonds support the investment objective, meaning only if the market conditions make the government bonds more favorable than corporate bonds. This follows with an elaboration on the more complex bonds. Here, the prospectus provides the relevant investment constraints of max 40% in securitized assets, of which max 10% in CLOs, CMOs, and non-agency MBS. Also stated is a max 10% in contingent convertible or COCO bonds. The fund has flexibility to shift the portfolio fully to cash equivalents during exceptional market conditions, though it should be rare for this to happen, as the fund would be realizing losses and may miss the recovery phase during such times. The prospectus then goes on with more generic investment constraints and derivative usage that is common in most other funds, so I will not run through this. Last but not least, there is a section called Long-Short Investment Strategy. True to Man Group's hedge fund roots, this is actually not a normal long-only bond fund, but has a credit long-short approach. The fund has a typical range of 80 to 150% for long positions and 0 to 50% for short positions, meaning it can have a 200% gross market exposure if the manager feels confident on both the long and short positions. Moreover, these are the typical ranges, and the fund actually has no constraint on this and can go beyond these ranges. Derivatives are expected to be used, especially in creating synthetic short positions, but can also be used for long position exposures as well. Running a long-short strategy obviously can create higher return potential than a normal long-only bond fund, but comes with increased risk as well, because there are more positions to manage and the fund can potentially suffer more if the manager gets his views wrong. The fund is, however, not being described as a credit long-short strategy, so investors do need to take note and be clear about the additional risks and complexities involved. This is also the reason why I use this alternatives slide template instead of the usual red color template. The Man Dynamic Income Fund was incepted only in 2022, so it has only almost 4 years of track record. The institutional US dollar share class is the earliest incepted class. The fund has been gaining quite a lot of interest despite its short lifespan, and now has a very decent AUM of over 7.8 billion US dollars. Portfolio information is only found in the fund fact sheet, which shows the breakdown data based on net exposure. Here, we can see government exposure is negligible, which shows the fund is really primarily a corporate bond strategy. Banks and financials exposures are rather high, with a combine of 45%. If we compare the fund against a broad corporate bond index, using for example iShares Global Corporate Bond UCITS ETF, we can also see the fund has less non-cyclical consumer and technology exposures, so the fund has some clear sector biases currently. Geographic breakdown is also interesting, with the fund having almost half in Europe including UK, and is therefore a key differentiator compared to many other popular bond funds in the market that have a high US bias. Even if we compare against iShares Global Corporate Bond UCITS ETF again, we can see the clear US underweight in the fund. Again, this would be good for investors looking for a solution with lower US exposure currently, and especially one that is corporate bond focused. Credit rating breakdown is where we see the aggressiveness of the fund strategy. The fund has over 75% allocated to non-investment grade rated bonds, and is not shy to have more allocated to single Bs instead of double Bs, showing that the fund will not hesitate to take on more risk in exchange for higher returns, as long as the manager thinks the risks are manageable and worth taking. This fund is therefore not suitable for investors who are looking for investment-grade focused solutions. Maturity breakdown shows the fund is mainly allocating to around 4 years maturity, which is a common level for many bond funds currently, suggesting this is a sweet spot for optimal yield. Portfolio statistics show that the modified duration and effective duration are on the low side at around 2.3, suggesting the fund has some concerns on interest rate risk and prefer to reduce it slightly. Yield to maturity is high at 8.48%, a reflection of the high yield exposures in the portfolio and likely boosted by the long-short exposures. For comparison, the yield to maturity of the iShares Global High Yield UCITS ETF is only 6.31% currently. The fund fact sheet also provides asset class breakdown and buy exposure as well. Here, it looks like a normal bond fund with nearly 100% long exposure and almost no short exposures. But do bear in mind this is only an end-of-month snapshot, and we wouldn't know how the portfolio moves through the month. It would be good if the fund can provide a historical long and short exposure trend chart for investors to better understand the flexibility of having a long-short strategy. The fund fact sheet also provides top 10 issuers data, but interestingly does not disclose the actual issuer name and instead shows region and sector and average credit rating. Hedge funds normally are sensitive on their short positions, as it is easy for other parties to counter their positions if known, and therefore short names are kept hidden while the long names are normally okay to disclose. Perhaps this fund is extra sensitive and decides to hide all the issuers' names, although this basically results in a top 10 table that is not too useful. In any case, the fund is decently diversified with over 250 issuers, although the 350 total positions looks a bit low for a bond fund of this size compared to other normal bond funds in the market. Man has some of the most confusing share class definitions amongst fund providers, and therefore it is quite painful trying to understand the differences in the long list of share classes for the Man Dynamic Income Fund. The easy part is that I represents institutional share class that has a higher minimum investment requirement, while D represents retail share classes. Besides the base US dollar class and Sing dollar class, the fund also offers Aussie dollars, Swiss franc, euro, and sterling currency classes. Non-US dollar classes are currency hedged and has a H added to the share class naming convention. Besides accumulation option, some of the share classes also offer monthly net distributions as denoted by net DISTMO. We will go through the distribution details in a while. Now here comes the complicated part. The fund has a long list of share classes with additional abbreviations added, resulting in different fee structures. For the purpose of this video, I will focus on those that have Sing dollar class available, that are D, DB, and DU. The relevant US dollar classes are included as well. So D is the standard retail class and I is the standard institutional class, as mentioned earlier. Adding a B or a U seem to cater to specific groups of investors as per the rather vague description in the prospectus addendum. What I suspect is that these may be share classes with different fee structures and are offered via different groups of distributors according to the distribution agreements between Man and these distributors. Let's look at the fee structure differences. The normal D class have a management fee of 1.35%. Adding other expenses gives a total expense ratio or TER of 1.56%. DB classes have instead 0.4% higher management fees, resulting in a higher TER of 1.96%. Assuming normal distribution arrangements, this additional fee layer would likely translate to additional distribution fees to the banks that offer this share class. DU classes, on the other hand, have the same 1.35% management fee as the normal D classes, but have a lower TER of 1.29%. Other expenses can be negative, so this suggests that a fee discount, usually temporary, has been given to this share class. Temporary fee discounts are commonly used to attract investors to the fund, especially if the impacted share class is offered exclusively by one distributor. You can see by now the retail share classes have a more expensive fee structure than typical bond funds. Investors looking for the cheaper share class obviously should try to find distributors that offer the I classes, assuming the minimum investment requirements are met or waived. I classes have a significantly lower TER of 0.81%. One more thing for investors to note is that these share classes should not have subscription fees according to the prospectus. Therefore, you can refer to the prospectus and debate with your bank or distributor if they try to charge you a subscription fee. Out of the different retail share classes we covered just now, the Man Dynamic Income Fund seems to have distribution options only for the D and DB share classes, with monthly distributing frequency. I can't seem to find distribution data in the fund webpage and documents though. Maybe the data is hidden somewhere obscure, but Man should improve in this area to be more investor friendly, especially those who consider this as a potential high income generating bond fund solution. Here are the distribution history obtained from Morningstar for the 4 share classes. The DB classes have a short track record as they were incepted only in late 2025. From this data, we can calculate and derive some observations. For income investors, the key observation is that the income amounts and yield percentage fluctuate through the months, meaning these share classes do not have a smoothened payout policy. The fluctuations can vary from a high 8.36% annualized yield down to 5.65% within a few months. So the fund may not be suitable for investors looking for stable income distribution. That being said, the distribution yield of the fund is high, with a low of 5.6% to a high of 8.4% as mentioned just now, based on this data here. It is therefore important to check that the fund is not sacrificing capital to generate the high payout yield. We can also observe that the distribution yields across these share classes are similar for the same months, suggesting there is no difference in terms of distribution policy between D and DB share classes. Additionally, since the US dollar class and Sing dollar hedge class have similar distribution yields, this means that the currency hedging costs in the Sing dollar classes are factored in the NAV instead of distribution. Here is a Morningstar chart comparing total return versus NAV for the D US dollar share class. We can see the majority of the returns are paid out as distributions, while the NAV has been maintained pretty stable so far and even has a very slight growth, which is good. That being said, it should be noted that the share class has a short track record of less than 3 years, and we will need to see the fund go through a notable market correction to better assess its responses and impacts. As the Man Dynamic Income Fund has a relatively short track record, I will be using the institutional I US dollar share class that has the longest track record to go through the fund performance. Performances of the other share classes can be estimated by calculating the TER differences that will translate to the yearly return differences. Based on the data in the fund webpage, the fund has exhibited a pretty stellar performance since inception, almost doubling its value currently. On annualized basis, we are looking at 19.6% per annum since inception. The fund has also scored double-digit returns for the past 3 calendar years, with 2023 the highest at 25.6%. High returns is not the only achievement for the fund, as it has managed to do so while maintaining a very low volatility that is seen in the performance statistics in the fund fact sheet as well as the cumulative performance chart. This has resulted in a very high Sharpe ratio of over 2 based on annualized statistics that I have not really seen in typical global diversified bond funds. The fund fact sheet also provides monthly performance data points, which is something more commonly seen in materials from hedge funds instead of typical mutual funds. This table further displays the capability of the fund to deliver a really low volatility performance. We can analyze the volatility from a few angles. Firstly, the drawdowns are all contained within 1 month and fully recovered in the next 1 to 2 months. Secondly, there have only been at most 1 monthly loss each year, with 2024 having no negative months at all. Thirdly, the monthly losses in 2025 and 2026 year-to-date are significantly lesser than those in 2022 and 2023, suggesting improvements in volatility management. From a volatility perspective, I have to say the fund has been pretty spectacular so far. Let's run some Morningstar chart comparisons. Here is the fund since inception comparing against various ETFs representing the broad markets of global government bonds, investment-grade corporate bonds, and high-yield bonds. With a significantly higher returns that is more than double of these ETFs, this suggests that the fund likely made good use of its long-short capabilities to boost the returns, but also the selection and management of bonds in the portfolio would likely have been good as well, since the volatility of the fund is noticeably lower than these ETFs. There is unfortunately no information on the exposure trends and attributions of the long and short books in the portfolio, that will further help investors understand why the fund has performed so well. Here is the same since inception chart of the fund, but comparing against some of the popular global diversified bond funds, as well as the more aggressive capital securities funds in the market. The fund again more than doubled the returns of all these other funds, exhibiting its superior returns that would be key to attract investors. Even if we look at past 1 year period when most bond funds have done well, the fund has still managed to outperform the rest with a high return and lower volatility. Investors should, however, note that the fund was only incepted in mid-2022 and hasn't gone through a major bond market correction yet. It would be good to see the fund successfully navigate through a major market drawdown that would further reinforce its low volatility capabilities. Also, while the fund returns are stellar, investors do need to be reminded that this is more of a credit long-short strategy instead of a typical bond fund. So the fund definitely has more tools to help boost the returns that comes with additional risks that investors need to be aware of. Last but not least, here is a quick comparison of the US dollar and Sing dollar hedge share classes. Currency hedging costs have been rather high in the past 1 year, and the fund has around 3% currency hedging costs for its Sing dollar hedge share classes, similar to other bond funds in the market. The fund does still have a pretty high return for its Sing dollar share classes even after the currency hedging costs, so this may still be attractive to Sing dollar investors. With that, let's summarize our findings. Man Group is a leading global hedge funds and alternative firm running a multi-manager structure. It has a long heritage and currently manages over 220 billion US dollars of assets across a diverse range of solutions. The Man Dynamic Income Fund is a solution from the Man GLG business arm. While the fund materials seem to feature it as a typical global diversified bond fund, this is actually a long bias credit long-short strategy. The fund has a high focus on global corporate bonds and, to a lesser extent, securitized assets. Portfolio is also geographically diversified. This is therefore suitable for investors looking for less US bias and government bond bias solutions. The fund, however, has no credit rating constraints and can heavily overweight in non-investment grade positions. While this is not necessarily a bad thing, as it is probably one of the reasons for the high returns of the fund, investors do need to be prepared to take on the non-investment grade exposures and associated credit risks. Given this is a credit long-short strategy, the fund unfortunately does not provide its long-short exposure trends and performance attributions, making it difficult for investors to better appreciate the fund strategy. The fund has way too many share class variations with different fee terms that are not really defined or explained well. Man should try to tidy this up. The fund was incepted only in mid-2022, giving it a slightly short track record compared to many established bond funds in the market. That being said, the fund's performance since inception is stellar. The fund has exhibited superior returns and better volatility management compared to most established bond funds. This is obviously attributed to the fund's long-short strategy, but it well deserves a praise nevertheless. In conclusion, the Man Dynamic Income Fund is a very strong performing credit long-short solution. Though its track record is a bit short, and it hasn't gone through a major market correction yet to reinforce its capabilities. For investors who understand the fund's strategy and additional risks involved, this can potentially be a complement to existing traditional bond exposures to help boost overall returns. This concludes my absolutely biased comments on the Man Dynamic Income Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.